QQQM crushed it recently with 137% over 3 years. But OEF's steadier approach wins the longer race at 114% over 5. Now let's shift gears and look at OEF's 114% crushes, QQQM's 105% over 5 years. Proof that short-term winners don't always dominate the long game. But here's where it gets interesting. QQQM absolutely crushed it, with a 137% 3-year return. That's nearly 30 percentage points ahead of its main competitor. Let's zoom in on this. OEF's 108% gain over 3 years is solid, but it's clearly losing ground to QQQM's tech-driven momentum play. In plain English, here's the race car breakdown. QQQM's built for speed in the short term, while OEF is designed for the long haul. Different engines, different results over time. Here's where the story takes a turn. OEF's 114% 5-year return, crushing QQQM by 9 points, proves steady wins the race. Consistency beats flashy, short-term bursts every time. Let's break this down further. QQQM doubled your money over 5 years, but that wasn't enough to keep pace with the top performers in this battle. Over the past year, these two are virtually neck and neck. QQQM's 21% just barely edging OEF's 20%. Practically identical performance here. In plain English, here's the marathon runner analogy in action. QQQM sprints ahead early with explosive gains, while OEF runs the steady race that wins over time. Different strategies for different races. Let's dig into the details. OEF's 0.8 Sharpe ratio means you're getting solid returns without taking crazy risks. That's the efficiency investors look for. Here's where things get revealing. QQQM's 0.6 Sharpe ratio shows poor risk-adjusted returns. You're shouldering significant volatility without getting properly rewarded for it. Now, let's put this in perspective. OEF's Sortino ratio of 1.0 beats QQQM's 0.8, meaning it handles downside risk more efficiently when markets drop. Think of OEF as a well-tuned car engine and QQQM as an inefficient one. Both deliver power, but OEF generates smoother returns per unit of risk taken. Here's the thing though, 23% volatility means you're in for wild swings. This isn't a smooth ride. It's permanently choppy territory. Let's take a closer look. OEF's 18% volatility means smoother rides during market chaos. 5 points lower turbulence makes it easier to stay invested long-term. Now here's where it gets tricky. QQQM's higher beta means you're signing up for wilder swings. 20% more volatility than OEF's steady market matching ride. In plain English, here's your volatility reality check. QQQM's like a thrill ride. Wild swings, bigger drops. OEF, that's the family-friendly coaster with smoother, gentler moves. Pick your adrenaline level. Let's see how this plays out. QQQM's worst drop hit 35%. That's the gut-wrenching reality you'd face holding through a major market crash. Here's what really matters. OEF's maximum drawdown hit 26%, 9 percentage points less brutal than its comparison, making crashes psychologically easier to stomach. Now let's connect the dots. QQQM bounced back to break-even in just 404 days. Pretty impressive resilience, recovering from its worst drawdown in barely over a year. In plain English, think of maximum drawdown like a mountain summit hike. QQQM tumbles down a steeper cliff but sprints back up faster, while OEF takes a gentler fall and crawls back more slowly. Let's unpack this a bit. OEF took 421 days to recover, That's over a year to just break even, despite losing less than QQQM. All right, pause time. Who's taking this one? QQQM or OEF? Drop your vote now. Now let's flip the script. QQQM's betting big on tech with 53% allocated there. That's putting over half your eggs in one sector's basket. But there's a catch. OEF keeps tech at 40%. Still meaningful exposure, but you're getting way better diversification across other sectors too. Here's where these funds couldn't be more different. QQQM's virtually ignoring financials at 0.31%, while OEF holds a full 12%. In plain English, think of your portfolio like a pizza party. QQQM loads up the tech guests with most of the slices, while OEF keeps things balanced, spreading portions more evenly across all sectors. But here's where it gets interesting. QQQM's 53% tech allocation powered that huge 137% 3-year return. Concentration amplifies gains when your sector's winning big. Let's zoom in on this. OEF's 12% financial allocation cushions tech crashes. That's how balanced diversification delivered a solid 114% over 5 years. In plain English, QQQM's egg basket analogy nails it. You're loading up on tech stocks for higher returns. But if that basket drops, you're cleaning up a lot more broken eggs than a diversified fund. Here's where the story takes a turn. At just 0.15% annually, QQQM keeps your costs low, so more of your money actually works for you long term. Let's break this down further. OEF's 0.2% fee seems tiny, but that extra 5 basis points quietly eats into your returns year after year. Here's what really matters. $5 per 10,000 doesn't sound like much, but over 20 years, that gap compounds into serious money you're losing. In plain English, think of expense ratios as couch change. QQQM saves you an extra nickel per $100 compared to OEF. Doesn't sound huge, but those nickels compound into serious money over time. Let's dig into the details. QQQM's pretty stable. With just 27% turnover, about a quarter of its holdings swap out yearly, keeping things steady. Here's where things get revealing. OEF's got a real buy and hold strategy here. Just 3% turnover means they're barely trading at all, keeping things super stable. In plain English, portfolio turnovers like juggling balls. QQQM constantly swaps them out chasing momentum, while OEF keeps the same ones rotating. More turnover means more trading costs eating your returns. But wait, there's more to this story. QQQM's 27% turnover means you're paying for constant trading and taxes, while OEF's 3% keeps your money working efficiently. Here's the thing though. QQQM is chasing bigger returns with that 137% 3-year gain, but you're paying for it with higher volatility and deeper drawdowns. OEF is delivering better risk-adjusted performance. That 0.8 Sharpe ratio tells the whole story. Let's take a closer look. QQQM's price-to-sales ratio sits at 5.8. Investors are paying nearly $6 for every dollar these companies earn in revenue. Now here's where it gets tricky. OEF's priced at 4.3 times sales. That's 1.5 points cheaper than its competitor per revenue dollar. In plain English, think of price to sales like swimming pools. QQQM's pool charges higher membership fees, while OEF offers more swim time for your dollar. Same water, different pricing strategies. Let's see how this plays out. Tech's 5.8 price-to-sales ratio fueled that 137% gain, but now there's less room left for valuations to stretch further. Here's what really matters. OEF's valuation edge shines here. A 4.3 price-to-sales ratio suggests room to run, with historically strong 114% 5-year returns. In plain English, here's OEF's edge. You're buying stocks at a discount. When they grow, your percentage gains are bigger, like catching a market crash recovery from the bottom instead of halfway up. But hold on a second. QQQM's got serious scale here. 70 billion in assets means you'll get tight spreads and won't move the market when trading. Let's unpack this a bit. OEF is sitting at $29 billion in assets, substantial for sure, but still less than half of what QQQM's commanding right now. Here's the key takeaway. QQQM's crushing it with 70 billion in assets, more than double OEF's 30 billion. Investors are clearly choosing NASDAQ exposure here. In plain English, assets under management tells you the fund's size. Think pizza slice. QQQM's the family-sized pizza serving many slices, while OEF's the personal artisan pie, both quality, just different scales. But there's a catch. When 53% sits in tech at a 5.8 valuation, you're betting big on an expensive sector. One pullback hits hard. Let's get into the weeds here. OEF spreads its bets wisely. 12% in financials keeps things balanced, while that 4.3 valuation helps avoid those wild swings. In plain English, QQQM's heavy tech concentration is like swimming with weights strapped to your ankles. When the tech sector sinks, those expensive stocks drag you down twice as hard as a balanced portfolio would. But here's where it gets interesting. QQQM's chasing winners with 27% turnover. Great when tech's hot, but you'll feel the whiplash hard when the momentum flips. Let's zoom in on this. OEF's 3% turnover means it's barely trading, holding tight through market swings with conviction in its long-term picks. In plain English, think of it like dance partners. QQQM is constantly switching to catch the hottest moves, while OEF stays loyal all night long. Two totally different strategies for chasing returns in the market. Here's where the story takes a turn. QQQM's massive 137% return came from perfect timing. Its 53% tech bet paid off when the sector absolutely exploded. Let's break this down further. OEF's 114% 5-year return proves diversification works. Spreading across sectors with lower valuations cushions tech crashes better than concentration. In plain English, here's the storm analogy in action. QQQM thrives when skies are clear, enjoying full upside with zero protection. OEF builds defensive shields, ready for turbulence, less thrill, more survival strategy. Now, for the real question. Lower fees sound great until hidden costs like turnover eat your savings. QQQM's 0.15% isn't necessarily better than OEF's 0.2%. Let's dig into the details. OEF wins on risk-adjusted performance. A 0.8 Sharp and 1.0 Sortino show. It's delivering better returns for the risk you're taking. In plain English, think of it like buying a car. QQQM's got that attractive low sticker price, but you'll burn more gas and hit the repair shop more often than OEF's solid reliability. Now let's put this in perspective. Higher volatility means you're more likely to panic sell at the worst possible moment and miss the recovery entirely. But wait, there's more to this story. Here's the surprising truth. QQQM's steeper drop recovered faster than OEF's shallower one. Deeper doesn't always mean longer pain. In plain English, QQQM's volatility is like a roller coaster. When the drops get scary, investors panic and bail out, missing the recovery climb. That's the emotional toll of high volatility investing right there. Let's take a closer look. OEF wins on long-term stability and risk control, while QQQM takes short-term gains and costs. Your priorities decide the winner here. Now, here's where it gets tricky. Your choice here really comes down to one thing. Are you chasing tech thrills or seeking steadier, diversified growth? In plain English, think race cars here. QQQM's the aggressive speedster chasing maximum acceleration, while OEF's your consistent driver winning through steady, reliable lap times. Different strategies, different styles. Let's see how this plays out. QQQM's for risk takers chasing max growth with 35% drops, while OEF offers balanced returns with gentler 26% downside protection. In plain English, here's your marathon runner matchup. QQQM is the sprinter chasing explosive tech gains, while OEF is pacing itself for steady, diversified endurance. Pick your race based on how much volatility you can handle. Now let's connect the dots. Standard disclaimer slide. Do your own research and consult professionals before investing. But hold on a second. That's a wrap. Hit subscribe for weekly ETF breakdowns that cut through the noise with data you can actually use.